Profitable investing is this never-ending battle between being adequately diversified and also wanting to have your money concentrated in assets that are performing the best. And as you're about to find out on today's episode of ETF Battles, we're going to illustrate this never-ending struggle of diversification versus concentration. Welcome to the show, everybody. I'm Ron DeLegge, and today's matchup is between the SPDR Dow Jones Industrial Average ETF, that's ticker symbol DIA, versus the Vanguard S&P 500 ETF, that's ticker symbol VOO. Another way to think about these two funds are the eldest sons and daughters of the Brady Bunch. For example, DIA was launched way back in 1998 when Jeff Bezos and Elon Musk were just 10 years old. That's how long it's been. And if you're new to the show, let us know how you've been enjoying the program. Hit us up on our YouTube comment section, ETF Battles. Be sure to hashtag that. And be sure to subscribe to the program. Never miss any of our weekly episodes. So helping us to judge today's skirmish are two New York Mets fans. Last time I checked, the Mets were still in first place. We've got Todd Rosenbluth, head of ETF and mutual fund research at CFRA, and John Davi, founder and CIO at Astoria Portfolio Advisors. Judges, great to see you again.
Great to be with you again, Ron.
Hey, Todd. How are you? Hey, Ron.
So we've got our four battle categories: cost, diversification, performance, and then we've got our mystery battle category where you, the judges, get to pick whatever factor or several factors that you would think are important to this particular showdown. I've got my battle scorecard ready there. As you can see, it's blank, and I'm going to be filling it out real time as we go through each of these battle categories. You are going to pick DIA or VOO as the battle winner. You can also opt for a split decision. And at the end of the show, we're going to declare an overall winner. So you've got 30 seconds in each battle category. We're going to begin with the first one, which is cost. Todd, get us started.
Well, Vanguard S&P 500 ETF is among, if not the cheapest of the large cap ETFs available. Just 3 basis points. It's actually tied with an iShares product for among the largest ETFs that charges that extremely low cost. It's also extremely liquid. So from a trading cost perspective, there's a lot of volume that's behind this ETF, and that keeps the spreads tight. It tends to trade in line with its net asset value. Those are some of the cost factors that we at CFRA think are important. So my battle winner on this category is VOO.
Okay, very good. And I like that nickname, the VOO, and that's good analysis. So how do you see it, John, in terms of cost? Who wins the battle?
You know, I don't have any disagreements with Todd. They are the battle winner, VOO. Whether you look at management fees, trading liquidity, discount to NAV. Honestly, I'm shocked that DIA is 16 basis points. In this day and age, with everything's cheap and costs are coming down, somehow, they've been able to keep that at 16 basis points. And there's still $20 billion in that ETF DIA. So it's a shocker that they've never reduced it. But, I don't look at DIA as like a true investment vehicle. It's just some index that's been around for, hundreds of years. So, I don't really pay attention to it. We would never invest in it per se. But I'd give the edge just from expense ratio to VOO.
Okay, very good. We need to move to the next battle category, which is diversification. We're going to stick with you, John. Who wins the battle between DIA and VOO?
DIA, has 30 stocks that make up the Dow Jones Industrial Average. VOO is the S&P 500, which I think actually has like 508 stocks. So, the more concentrated you are, the more risk in theory per se. So investors should keep that in mind. But VOO would win just from a diversification standpoint in terms of just the number of stocks in it compared to DIA.
Thank you very much. What about you, Todd? Do you agree with John's analysis on diversification?
So I agree with John. VOO is the winner in this category, but for a couple of different reasons beyond the stock. So the sector standpoint, there's a couple of sectors you don't get exposure to. Of those traditional GIC sectors, there's no real estate companies, for example, within the DIA product in the Dow Jones Industrial Average. It's also because it's price weighted, it's diversified in a different way. So Apple most recently had its weighting cut because the stock went through a stock split. That isn't necessarily the diversification that you would think. Apple is still the largest company around on a market cap standpoint, so it's the largest within VOO, but it's now much lower down, and you've got other companies that you wouldn't expect to be heavily weighted towards within DIA. So VOO, from a diversification standpoint, is the winner to us at CFRA.
All right, very good. We need to move on to performance, and we're going to stick with you, Todd. Who wins the battle in terms of performance between these two funds?
So it sounds like a broken record here, but VOO has outperformed DIA on a year-to-date, on a 1 and a 3-year basis. Those are 3 metrics that we focus on. It's more than 1,000 basis points, I believe, within the past year. Part of the reason why is there's just more growth companies. So yes, Apple is part of DIA, but you don't have exposure to many of the other growth-oriented companies that we've seen have been driving the other FANG-oriented stocks that have been pushing the market higher. So performance, hands down, again, goes to VOO.
You know, this battle is looking almost like a clean sweep. We're about halfway through this. It could be a clean sweep. We've only seen one clean sweep, by the way, in the history of this program, but this could be another case in which that happens. So let's shift to you now, John. In terms of performance, who wins the battle between these two funds?
You know, it's VOO once again. You know, I just want to point out that, you know, we tend to measure things from like a return per unit of risk basis. So that is called Sharpe ratio. And VOO has had better Sharpe ratio, you know, on a 5-10-year basis. You know, DIA is just like an outdated, you know, index methodology. I mean, it's at a minimum, they should equal weight it as opposed to price weight it. You know, I personally would never invest in the DIA. I just feel as though it's an outdated methodology. It's not really, doesn't really make any sense. They don't really have a representation of the true U.S. economy, even though they just added, you know, Salesforce.com into it, you know, kicked out, you know, Exxon Mobil. It's a weird index. I'm shocked that it actually has 22 billion in assets. It has poor performance compared to VOO, which is, I mean, that's the standard benchmark, you know, index that everyone, you know, is benchmarked to and utilizes. So VOO is the winner from a performance standpoint.
Okay, very good. Next up is the mystery battle category. This is where our judges can pick one factor or several factors that they think are crucial to the analysis that they're sharing with us. So let's stick with you, John. In terms of your mystery battle category, tell us what it is and who wins it.
You know, just from fundamentals, this may come as a shocker, but DIA, I would give a little bit of an edge in the sense that when I look at its yield, it's got a 2.4% div yield compared to the S&P, which is 1.9%. It actually has better net margins, you know, stronger ROE, stronger ROA, and a lower PE ratio compared to VOO. So it sounds good on paper, but then when you look at the component of it, as Todd has been, you know, alluding to, it's just got this weird sector composition, just, and then on top of that, the price weighting. But just purely, if I'm going to look at fundamentals, you know, I kind of give a little bit of an edge to DIA compared to VOO. But, you know, sometimes you can't just make investment decisions based on valuations. You've got to incorporate, you know, some other elements to it. Again, we would never allocate to DIA, but that is an interesting thing that it has slightly better fundamental ratios just on those 4 metrics that I identified.
Wow, that's a shocking. I was not expecting that from you, John. But you're a nonconformist, and you raised some great points about looking at fundamentals.
I'm wearing a gray sport coat. What do you expect, Ron? Yeah?
Very good. Well, you know, you're a nonconformist, so with your type of analysis, you know, we have to be ready for anything. But you, again, raised some excellent points about looking at fundamentals, higher yield, lower PE ratio, and some other points. So let's ask Todd, what is your mystery battle category, Todd, and who wins it?
So I tend to bring the same mystery category time and again. CFRA does an independent rating of ETFs that include cost, but also risk and reward. And this is a tie for us. Both DIA and VOO have a 5-star rating from CFRA. So part of that is our assessment of the holdings from a risk and reward standpoint. Part of it is that risk-adjusted performance that John touched on. I talk about the absolute performance, but from a risk-adjusted standpoint, and then cost is folded in there. So while we love all of our children equally, these are both 5 stars. You can clearly see as we'll get to the wrap up as to which of the winner it'll be. But both these ETFs, DIA and VOO, earn CFRA 5 stars.
All right. So that's a split decision on the mystery category. Now we're going to let our judges weigh in with their final opportunity to tell us who their overall battle winner is. Todd, how do you see it between DIA and VOO?
So from a cost standpoint, from a performance standpoint, from a diversification standpoint, those top 3 categories, VOO was my winner. And so despite a split decision, despite the fact that these are 2 5-star rated ETFs, given the criteria that we have here, VOO is the large cap winner in our book. All
right. Let's shift to you, John. Who is your overall battle winner between these 2 ETFs?
I would say VOO for a lot of the reasons Todd mentioned, cost, diversification, performance. DIA just has a really outdated index methodology. It doesn't make any sense to me. I don't think anyone really should invest in a price-weighted basis. As I keep saying, I'm shocked that it's $22 billion in that ETF. So I give the overall winner to VOO, just from all those attributes that Todd and I have been discussing.
Well, our judges have spoken, and the overall battle winner of this showdown between DIA and VOO, also known as VOO, is VOO, which outperformed its peer in terms of cost, diversification, performance. Really, the only area where our judges disagreed was in the mystery battle category. Todd had a split decision there, and John opted for DIA. But when we look at the whole big picture, it was VOO as the winner. And a couple of key takeaways from today's battle. First of all, the only investors who should not diversify are those who are right 100% of the time. Next, certain yardsticks like the Dow Jones Industrial Average may be popular or well-known, and they're okay maybe as barometers, but maybe not necessarily the best or optimal choice as an investment vehicle. So thank you very much to Todd and John for their excellent analysis and in helping us to sort through today's battle.
Thanks, Ron.
Thank you.
So before signing off, which ETF battles would you like to see in our next episode? Well, post your thoughts on our YouTube comments section. Give us your ticker symbols. Be sure to hashtag ETF Battles. You can also find us on Twitter at ETFguide. I'm Ron DeLegge with ETFguide TV. Thanks for watching. We'll catch you next time.